Good afternoon, Kerin.
Good afternoon, Jim.
You today?
I'm very well. How are you?
Brilliant. I love your backdrop news channel. This for the news. Okay, guys out there, you're watching or listening on the podcast later on. We're going to be talking today about Kerin's going to be covering some things in the news quite recently about average rents and that. We're also going to be talking about number crunching, probably one of the most important key indicators for good number crunching. Financial management is every single business, and the landlord and the rental of the yield of the buy to affect your property in the first place. After that, it can help you monitor investments and ongoing profitability and performance. But let's cover the news first. I mean, if we dip in and dip out, I have big broadband wired, and I have difficult. How let's go for it. News so far. What do we want to cover?
So obviously we've seen a massive increase in living costs just now. So this is to see rent, is it the exception? Unfortunately not. So we've been having a wee look at the private rental sector and the rent increases that tenants have been facing recently.
Yep.
So Fife's average rent is £616. So this is taking into account obviously all the areas, different types of property. However, this is lower than Scotland's average of £693. But good news for investors.
£616. That's a huge amount for an average, isn't it? I mean, I'm on the cusp of the average and just over the average with most of my rents, and most of them are actually probably well below the average. So it just kind of shows you if you plan right, then possibly if something like rent controls do come in from Patrick Harvey and the Greens through the SNP channel and the government, then potentially we're the other side of the average rents, therefore, and most of our landlords are the other side of the average rents as well. You know, the downside. It's not really a downside. Really, downside's upside, isn't it? Because you're we talked about sensitivity analysis, and we talked about opportunity cost, and we talked about probability risk analysis as well on previous shows. But it actually shows you we're quite, dare I say, hedged against that potential. Where if a rent control did come in, we're kind of the other side of the average, the good side.
Well, regardless of obviously Scotland's average being slightly higher than Fife's, obviously there is good news for landlords on this, as since 2010, this gap has been closing and Fife has seen a steady increase in the rental values. So it also goes to show that Fife is a good area to invest. Obviously, we can see that increase coming into our rental values across the board for it.
Why do you think Fife is a good area to invest? What is the potential here? You know, and what is the best areas in Fife?
Fife is very pockety. We've obviously covered this on various shows that there's very different areas to Fife, so it really depends on what kind of market you're looking to attract.
Yeah.
And that is why it is quite good, because there's various different markets that you can go into within the Fife market. And obviously you can pick up depending on different areas. There's still some good deals to be had as well. Whereas if you're in Edinburgh, for example, you're paying prices for a property already. So you're looking at a lot more outlay in the first instance, as opposed to in Fife. You can be picking up something a bit cheaper, but still be getting a good rental return on it.
So do you think people outside the area should potentially invest in Fife? Is that what you're thinking? Because
I think as long as a landlord is prepared to put out a good quality of property, then yes. Obviously, we do not want to be attracting cowboy landlords to Fife, because we want to see a good market out there. We don't want to be seeing these properties that people are coming out from either in or out the area and picking them up and just doing cowboy jobs on them and putting them out for people to be living in. I think it's making sure
we could talk about the one that I bought recently, you know, Inverary. So Inverary, I keep getting mixed up between St Morans and Glenoffice. Inverary, not Inverary. So Inverary I bought. I bought that for a really good price, but I've got to spend probably about 15,000 on that to get it through a refurb. But that will definitely add value, won't it?
It will, and that's what we've seen even just now, looking at the sale side of properties as well compared to what they can achieve, even just for your own ones that we've been doing. And obviously we have a few other landlords that have been going through the same journey as yourself, buying properties, doing the work to them, and then you're buying that property at the lower end of the value, doing the work to it, spending the money on it, then you're getting your rent coming in for it, giving you the income. And if it does get to a point where you're looking to sell it further down the line, there should be the potential there that you've made a profit on it for the work that you've spent on it.
Yeah, because you're kind of locking in the increase in value, aren't you? You're not necessarily getting it really below market value or below what the actual value is. You're paying a fair price for it, but you're actually seeing the uplift in the demand because you're actually refurbing it, and it's more attractive to a wider audience. Therefore, more people are prepared to pay that price because they can, if you want to sell it, they can mortgage it at a higher rate, can't they?
Exactly, and that's the thing, when you're looking at a property to buy, you tend to find more people are interested in the ones that are already done up, because people might have the money there to put the deposit down for a mortgage, but they might not have the money there to put it down for the work that a property is actually needing done.
So that makes absolute sense. Would it be a suggestion then to, I don't know, would it be a suggestion to buy cash and then refurb and then remortgage later on? Or would it be a suggestion possibly, that's another story completely, isn't it? That's a complete show in itself, isn't it? And we have done that in successive shows, but repetition's the mother of all skill. And going over that again in another show, it's maybe another one that we'll pick up later on about that. If you're listening out there or you're watching it out there, please feel free to ask any questions. We're happy to answer them live on air. If it's anything to do with wealth creation, it could be anything. Look at how crypto's dropped through the floor. It's like absolutely crazy, eh? It's like there's people on there with tears in their eyes, and they've put everything in. An MMA fighter or whatever he does, fights in a cage anyway, he's put every single penny, he's got millions into crypto, and the bottom's fallen out completely, and he's lost everything. 40 million he's lost, and that is absolutely crazy. And all his efforts have disappeared overnight because crypto's dropped like a stone. I tell you, property investment is the best asset class ever. It is literally a vehicle. It will pay you to wait over the process while the income goes up. And that's the clear indication about where we should be with that. Anyway, so let's talk about, again, what happened between 2020 and 2021 then with the average rent increases on, can you break that down to room basis?
Yes, so we've seen an increase across the board for it. So the various different types of properties have seen an increase. So your average for a one-bedroom property has had an increase of 4.7%, a two-bedroom by 5.2%, three-bedroom by 8.4%, and a four-bedroom by 16.5%. So there's been a great increase over all different types of property. It's not to say that one is attracted more than the other. Obviously, they've all seen a really good increase going on there.
For a four-bedroom, that's actually quite a lot. That's 16.5. I mean, that's literally a lot more than inflation. That's almost double the inflation rate.
I think there's not a lot of four bedrooms on the market, so people are willing to pay that wee bit more for them, because your average, I would say, is kind of between 1 and 3. That's typically the sizes of properties that we've got up for rent across the board. So seeing those four-bedroom ones coming up, there's not very many of them, so people are willing to pay that bit more to have that size of property, because ultimately they've got kids, they need the space for it. But there's not a lot on the market in that aspect.
So what about one-bedroom shared properties? What's happened with that then?
So that is the only one that we have seen a decrease in. So the one-bedroom shared properties have had an average decrease of 6.9%. So this is taken into account, for example, like your HMO style properties.
Yeah.
I can only assume with COVID, people have not wanted to share with random people quite so much. So people will be coming out of the HMO aspect and going into more private lets, where it's either joint tenancies or sole tenancies.
And that's probably from a prospect of obviously social distancing, but then they've also I don't want you under my skin. That's literally it. It's like, I don't think I could put up with you self-isolating if this happens again. So we need to get out of this agreement where we're sharing an HMO. Probably that's driven it as well. What do we find at lower ends of the properties then? What's happening with that?
So with the increase in the local housing allowance, we've seen an increase even in the lower end properties. Because this has come in, it has driven up the bare minimum basically of what people are entitled to. So for example, your one bedroom housing allowance is now up at £373.
So what is for people out there listening in, when you talk about the one bedroom housing allowance, what is that?
So this is for people that are in receipt of universal credit, for example. So people that are not working, on job seekers, that are entitled to universal credit. So this is the housing allowance that people are given to find housing within that sector. So different rates obviously apply for different people. It depends completely on your circumstances. So for example, you're over the age of 35 and entitled to a 1-bedroom housing allowance. The government would give you £373 towards your housing allowance for it to cover your rent each month.
It's from the point of
Maybe a bit.
200 at that. It's gone from right up to 375 sometimes. I mean, areas like again.
Yeah, so we've seen an increase across the board in the local housing allowance from your 1, 2, 3, 4 bedrooms. They've all seen an increase. So this has driven up the local housing rates for it. So this has had an impact on the private sector as well, because this is what, so for example, a property that used to be on the market at 350, if you had a 1-bedroom, for example, in a certain area, the tenant, if they were in receipt of universal credit, would be entitled to that £373, which has then driven up the value of the property to that level. So you're now looking for your average in certain areas to be that 375 for the rent, as opposed to what it would have been a couple of years ago at the 350 rate.
Yeah. So I said at the broad now. So just be with us. I noticed Sean had actually said my sound had gone there potentially. And can you still hear me okay, Kerin?
You're coming in and out. I'm trying to pick up on the rest of it.
That's very for you. But I tell you what, I'm not go anywhere else because you don't get 1 gigabyte broadband anywhere else from anyone else on a personal stream. So I'm actually quite surprised it's actually still in and out here. Let's talk about number crunching then. Do you think the market will slow down? Just a quick one. Do you think the market will slow down in terms of rentals?
I think we've seen a slight slowdown for it. Obviously, the demand for property is still very much outweighing the supply that is there. However, with the rise in living costs, I've seen people are not willing to pay the crazy amounts that they have in the past. I think that massive surge that we had coming out of lockdown has slightly eased a wee bit. So we are seeing a slight decrease to it, but not enough that there's still very much too many people looking compared to what's actually on the market for it.
Do you think the increase in utility costs and the increase in other costs, do you think that will have an impact on rental levels? Or do you know? I mean, Patrick Harvey said the classic example about, if you had to choose between feeding yourself or your rent, just feed yourself and forget about your rent. I mean, I kind of disagree with that, but he did it a bit more impolitely, if that made sense.
It is. We've seen people that the rise in utility bills and petrol as well. I mean, fuel for people just trying to get to your work in the first place can be tricky now. So I think we've seen that rise in living costs. People are not going to be willing to pay the crazy rent levels because they have all these bills that they're having to pay just to get by day to day now. So I think we do have to watch, just obviously on the rental side, that we're not overpricing things, because it is going to reach a point where people aren't going to be able to afford it, or they think that they can, and then they get in and they're paying these utility bills and they're going to end up in difficulty. So it's finding that right level of getting what a property is worth, but not overshooting it, so it's not going to be affordable for someone.
Yeah, so my thought process here, and I'm going to put you on the spot, and you don't need to answer it really, it's just a comment, is maybe possibly we should be stress testing rental levels for people, just to make sure that they can cover themselves and make sure they're aware that utility bills will increase. So they need to take that into account before they actually commit to getting a rental. That would probably be the best way forward. We would do, wouldn't it?
It is, and that's when it comes down to referencing people as well, and making sure that you're taking every step possible to make sure that they're going to have the finances for it in the first place and not get themselves into difficulty going down the line. Obviously, you never know what could happen, but trying to take as many preventative steps in the first place to minimise the impact of that.
Good stuff. Okay, let's talk about number crunching. This is what we want to talk about, the yields and stuff like that. I actually saw a brilliant quote this morning, and I'll just say it. The people who wonder whether the glass is half empty or half full miss the complete point. The glass is actually refillable. It's a good one, now. It's like, because often we see things as black or white. It's like it's either one or the other. It's like, wait a minute, the glass is actually refillable, isn't it? It's like, why would we not just go and fill it up again? So that's actually brilliant. So this brings me on to the number crunching, the essential guide to the yields for every landlord. I mean, as I said before, financial management is the heart of every successful business. Any business you know has been successful in what they're doing has proper financial management. And this is why it comes down to, as a landlord, the rental yield of a buy-to-let can affect whether you buy a property in the first place. After that, it can help you monitor your investments' ongoing profitability and performance itself. So while capital growth, and we talked about that a wee bit and touched on it, forms the backbone of most long-term buy-to-let strategies, rental yield is often what keeps you in the game. Now, I'll be honest and I'll say I have never, ever, and success leaves clues here for the last 30 years, I have never, ever looked at long-term capital growth as anything in my portfolio, as anything in terms of a return. My whole business has been based on cash flow every single month. Cash is king. Well, not cash is king, cash flow is king. You know, cash is trash. You know, you can just rip it up and throw it in the bin. It's a promise to say no. But what I mean is cash flow is the lifeblood of any buy-to-let investor business or any business itself. If you don't have cash, you're out of business. You could be extremely profitable. You'd have no cash to pay anybody. Therefore, they're not going to give you any more goods to produce any more goods. Therefore, you're out of business, even though you're profitable. That's how important it is. That's how the credit crunch, when finance immediately was restricted and it was all withdrawn, that's why it brought everybody else to their knees. So the natural flow of cash flow is the most important thing to any buy-to-let business. Capital growth, in my opinion, should be a secondary aspect. But we do talk about some people actually get it for capital growth. They look at long-term planning and they think to themselves they need a pension when they retire. However, you need that cash flow every single month. And it's important that you calculate these yields in order to do that. And we've done it on other shows as well, where we talked about it briefly in terms of sensitivity analysis, risk analysis, opportunity cost, and all these successive shows you can see on this playlist on this actual link itself. So you can see the playlist to these previous shows and previous podcasts as well. So capital growth conform. It determines your monthly cash flow and it shows you whether your rental property costs you or makes money every single month. This is the important point as well. You know, some people go out and get capital repayment mortgages. And say for example, your capital repayment, your rental, here we go, this is the difference. Your rental is 500 a month. Your mortgage is 500 a month, but it's capital repayment. So you're paying down the debt. So you really feel good about yourself. You're paying down the debt because you're paying down debt as you go. But what you fail to realize is you take the rental at 500, you take off the mortgage payment at 500, you've got absolutely no cash flow left to do anything at all. You're still paying down the debt and that's fine. You're still making money, as so to speak, because you're paying down the debt. And that's the difference. So if your mortgage for capital repayment and interest only was split, and I'll make it really easy and say 50-50, £250 would be interest only, £250 goes to pay down the debt. In essence, the taxman says that you're actually making £250 a month. So they'll tax you on that as well. They'll only give you deduction fully with a limited company if it's the interest against the rent. It's not the mortgage payment against the rent. So that's why most buy-to-let landlords go for interest-only mortgages. But again, we have talked about that. And if you look on the playlist, you'll see the one we did with Kessa Salimi, who's a mortgage broker. He runs Freedom Financial investments and mortgage broker services. So Kessa will be able to tell you about that, and you'll hear about that in previous shows as well. I think that's the great thing about us building up this knowledge of wealth in this library, so to speak, of all the experts before and all what their input is. And it's timeless information, isn't it? It really doesn't go out of date, does it?
No, it's good to know. And obviously, like you say, coming into businesses like this, you have the right people to speak to about it, which is so important. Making sure that you have access to all this information. It's there. It's just finding the right person to give you that information so you can be taking the best steps for yourself.
Yeah. And then it's the wee backup as well about the fact that the knowledge and experience that goes with that. So you can, if for anything, you could read things in theory. I mean, there's great theorists out there, but unless you're doing it, you don't know what the implications commercially on that and impacts in the long term. So why do ye matter? With that question about why rent.
So there's different factors that obviously take into account on rental yields. Various things such as how much of a good deal is it for the area. Like we say, Fife is very pockety. You have to make sure that you know your areas to make sure if this is going to be a good deal from you. The streets, even in Fife, you can have one side of the road which could be great, and then the other side maybe not so great. So making sure that you're knowledgeable about your area to make sure that that is going to be the right deal for you investing in that property.
Yeah. So if the income, like mortgage, that's important, isn't it?
It is. Like you say, you have to make sure that you're financially stable to be doing an investment such as this. Making sure that you can actually get a mortgage in the first place for the property is a key detail for it, because if you can't, then you're wasting your time looking at it in the first place.
I mean, as with any venture, it makes sense to gauge whether it's a viable proposition from the start to monitor that performance. And this is why we talk about there knowing the rental yield of the property to help you work that out. So it's also good for the point of the monthly and yearly profit, because it actually gives you a good indication. Your financial cushion as well in case of unexpected expenditure, and how well your money is actually working for you. So calculating rental yields is an essential tool to every landlord's handbook to quickly compare one property with another, see which one makes for the best rental investment. Let's look at that, actually. I'm going to get the spreadsheet up. I love a good spreadsheet. You know that anyway.
I know.
Let's have a wee look at the spreadsheet, and I'll show you. I'll share that with you in a minute. I'll just play a bit with this screen, and I'm going to do share, and I'm going to look at this scenario. So for anybody out there that doesn't know what we're doing here, we're just looking at various options. So for example, and we'll put 0 in there now. Here's a classic option here. This is a spreadsheet that we use all the time. I use it as a ready reckoner, and I've developed it over the years to give me the key indicators about where I should be looking for. So probably a classic out of rental yield to make it see if it's worthwhile at different levels is, for example, say for example, I bought a £200,000 property. So £200,000 property, I'll pay 4% ADS, which is the additional dwelling supplement stamp duty. Now, I'll probably be a wee bit more because over 145,000, it's 2% as well. So you've got a 2% on there. So it'll probably be 6 on that. But it's not 6 overall, remember. It's 4% overall for the ADS, the additional dwelling supplement, but it's only 2% of everything after 145,000 to 200,000. So you're only talking about 2% of that, which is another £1,000. So it's neither here nor there in the scope of things in the equation. So for the simplicity purposes, don't castigate me for it. I'll leave it at that just now because it makes it nice and easy. Normally, buy-to-let mortgages are 75% loan to value. So we'll assume minimum deposit is 25%. If you're going for a limited company mortgage just now, I'll just have a quick check. You're probably looking at round about the 3.5 level. In terms of a limited company mortgage, arrangement fee tends to be around about £1,000 or 1% of the loan. That tends to be what it is. And so, if you were buying a £200,000 property, Kerin, what sort of rental level would you be looking at for a £200,000 property? Maybe one that you've got. Maybe what would you buy for 200,000?
Realistically, if you're looking at 200,000, you're looking at a 4-bedroom at least house you'd be able to get. Obviously, it really depends, again, for example, on the area.
Yeah.
But we have I'll use this as an example. It's a bit of a different one because they have extended it and it's a stunning property, but that's even higher. I'm trying to think. You had to go 200,000, didn't you?
Yeah, ballpark 200,000. What would you be renting it for if it was at 200,000 a property? About 700, 750?
Yeah, probably.
Yeah. Okay. So
if you're looking at 4 bedrooms, or you're probably more kind of like the 850 mark.
Yeah,
but
okay.
we
So
have.
Let's go for 850. Okay. So you can see there straight away with 850, and we're fully occupied 12 months of the year. And then we've got the mortgage to pay at 75% loan to value at 3.5%. You're looking at, if you bought it for cash, on straight line gross yield, that was rent divided by the price, you'd be looking at a 4.9 return. But because you're it through the bank and you're leveraging 75% of it, the money through the bank at 3.5%, you're obviously less than what that is. Therefore, it leverages it up to 8.2% return before the overheads are taken off. So you increase your leverage position by 3%. There's always 30% of top line income. It'll take into account things like letting agent, any repairs, any insurance you need to do on the property, and just incidentals here and there. So net profit is round about 1,837, and that sounds all right for the actual net pay, which is net profit 60,000, which is the 58, the 4% AD, and legal, which is all that, only a 3% return. So what we talk about and why it's important is what happens with there. We've got 60, and something about 100,000. So we buy 100, we could probably get 2 of them. Something at 100, what would you be renting that for?
Maybe 550.
550. Okay, so 550. How that's jumped the money, we're only in about 60,000 there. 60,000, 60,000. We've got 2 properties actually come 6.2%. Leverage their 7.7. We're now at 4%. That's double the return, and yet we put the same money in. So see how yield is quite an important indicator.
It is, and that's the thing. You have to take this into account when your investment is actually going to be viable for you. Yeah. At the end of the day, if it's making a profit for you, that's great, but you have to have a safety net for it. So you have to be taking a section of that to obviously put aside for repairs that you have coming up. You never know what's going to happen. So you could have a washing machine stop working, could be something worse like a boiler, or you maybe need any repairs could come up. So it's taking into account obviously the rental value, whether it's going to be a good investment for yourself, but still obviously taking into account these extra things, such as obviously your stamp duty and things that all the way down to a nest egg for you for having that emergency pot if any repairs come up.
Yeah, perfect. So a classic example of that is then we're sitting at double that amount, and then we're sitting at a bigger margin. I mean, if we were back at originally at what we did at 1%, there, 200,000 in terms of the purchase price, we're down at 50. It doesn't give you margin 3.7. So if you look at rental income, you would drop quickly to 2%, up a percentage point straight away. If you maybe your occupancy rate went down again and you had it empty for 2 months, you'd almost be breaking even at that point. Whereas if you were at 2 of them at 100,000, you're spreading your risk now, because remember what you're doing now, and you're at 550. You're spreading your risk now, because what you're doing now is rather than actually what's the likelihood of both being empty for 2 months at a time, both of the times. That's where you spread your risk into a 50-50 option, because one will be filled longer than the other. So it de-risks the situation. So if you did go down to 10 months, you'd be sitting at 2,397 still. You'd still be more at 10 months occupancy for these 2 properties at that level, and still make a higher yield than the original 200,000 that you put in. So let's bring this down a bit more. So what would you be buying a 2-bedroom flat? Maybe in the Leavenmouth or Glenrothes area. What would you be buying that for? Probably about what, 70?
If we ran one, so we had one that I went to look at on behalf of an investor last week. So that was offers over 50,000 for a 1-bedroom flat.
Yeah. Okay.
So we'll run that one. See how that turns
out. So let's just say probably what would you pay for that? Probably 60 maybe at the very most.
We'll say 55.
55. Okay, let's look at 55. And then let's keep everything the same. So what would you rent that for?
So the rent for that would be 395.
Okay. So 395. So you've got 35 in. Now we've got 60 grand to play with. So we could maybe see that increase that to 3. It comes up to 53,000. So we're at 53,000. We've still got a wee bit more we can play with. Could we do 4? No, we're borderline 4. So we'll go to 3. So we're actually putting less money in. And we're using that, and we're doing 395. Now I've made you force that up by another 5,000 each. But when you look at that scenario in the 12 months, your yield has now gone at 8% gross, 18.3% with the bank's money. Leverage yourself 10% more, 30% overheads, as I say, the top line rent every single time. But your return, your net return, that's not you managing it, that's you investing it, is now 10.4%. Wait a minute. That is less than the same amount of the 62,000 in the first place, or the 60,000, and yet you're making 3 times the return, and you've got 3 properties that's invested over, and potentially it's the purchase price. Look, 165 instead of 200,000. So there's a huge return to be made there, isn't there?
There is. I think definitely if a landlord comes forward and they have a pot of money and they're not sure whether to invest it in one property or buy multiples, I would always advise buying multiples. Like you say, your risk is spread out over various properties. The chances of you having them all empty at once is very low. You can pick up the properties at the lower end of the scale, but still be getting a good return for them as well.
Yeah. So we changed that to 10. Just to see where we are, and we're still at 7.3% with 10 months occupancy. That's for 3 properties. That's every single property is empty for 2 months. Now that is near on impossible, especially compared to 1 property empty for 2 months on its own. So when you think about the logic, it's unlikely for 3 to be empty at the same time for the 2 months of the year than it is, less likely than it is for 1 property to be empty for 2 months. So again, that makes absolute sense, doesn't it? It is even double what it was originally on the full occupancy on the £200,000 purchase. So what is the trade-off here? Should we then just go for, should we all just go for lower value properties, or should we be looking at a mix?
I think a mix is good. Obviously, you can pick up the properties at different values, but still be getting a good return on them. So, for example, in Glenrothes is quite good for picking up houses. So you're looking kind of your 2-3 bedroom houses. You can pick them up for maybe about 80,000-90,000, depending if it's a 2 or 3 bedroom one. And then if it's a 3, for example, you're then renting that out at £650. Yeah. So you can be generating yourself a good return on it. And because you're looking at houses, you're attracting families that tend to stay longer as well. So you're looking at a higher occupancy rate for them. And likewise with flats, obviously, if you have a nice flat and you're putting a good product out there, you'll get somebody willing to stay a bit longer and keep up your occupancy rates for them.
A quick message to Sean. Sean, absolutely, we can send that spreadsheet out to you. However, there's a link in here to Richard Cook, the Lettings Director's email. If you send him an email, just click on that his email address in here, send him an email and ask him for a copy of that spreadsheet, and he will send that out to you personally and get in touch with you and touch base with you. So thanks very much for that, Sean. I really appreciate that. Now, what is a good rental yield? Many landlords ask that. It's the $1 million question, isn't it? What makes a good rental yield? Well, the answer is it's really different for everyone. We've kind of covered that, haven't we? I mean, according to research from Zoopla, the average gross yield across the UK for a purchase is, wait till you hear this, 4.86%. It's like, what? I'm looking at 15 and above as minimum. It's like, that's crazy when you think about it. And people are actually accepting that as the norm. That's a third of what I'm getting in terms of return. And I don't say that as a boasting thing, because somebody stood up one time and says, that's ridiculous, you're making so much money. Excuse me, that's my opportunity to understand the numbers and realize how it works and look at the occupancy rates and look at the base rates and also look at the mortgage rates and then tie that all in to get the right cash flow, to get the right purchase, to the right investment, to get the right tenant, and everything to marry up at the same time in order to get that return. And what do? You just go to someone and get it to do it for you. So it's my specialist knowledge that allows me to be able to do that. And that's what we impart every single month in our private Zoom sessions outside of here with Richard Cook as well. If you want to be part of that Zoom session on the last Thursday of every month at 7:30, again, email Richard Cook on this. His email address is in this link on this post. Email him and ask him to be part of that. You don't need to be, you could be starting off for the first time, you could just be investigating or looking into doing buy to let. You don't need to be involved in it, to be honest. You could hang around for a bit in various Zoom sessions in the weeks to come. It costs you nothing but a little bit of time to find out all the information to do that, and it's free. There is no upsell to you. You have to stress this. There's so many people out there that run free courses and say, get onto my free course, but they don't tell you that they're about to upsell you to a £5,000 course to do a 2-month seminar or a 2-day seminar with you. You know, we're not doing that. That's not what this is about. This is about helping people prosper and helping people increase their wealth as a result of that. And yeah, for the purpose of transparency, hopefully you'll use us as a letting agent, because clearly we know what we're talking about. And I hope that's demonstrated right now in here. So what is a good rental yield? Well, while it's a good benchmark figure, yields can be widely from region to region and even from street to street. Don't get in touch. Do get in touch if you'd like to know a bit more about the rental values in Fife. I mean, we've covered that a wee bit, but remember the initial yields are not fixed, and they're only half the story. As rents rise, the yield against your purchase also increases as well. Likely though, as interest rates rise, the yield decreases as well. So it's a flip side. So I must say investments can go down as well as up. There's my obligatory disclaimer or whatever it is. I don't see any investments going down over the medium to long term. Now, I mean, medium to long term, when I talk about that, it's 15 to 20 years. It's not what people talk about now. It's like, oh, your property will double in 10 years. Well, I'm afraid it doesn't. Unless you catch it right at the right time where there's an upsurge, like in 2000 to 2006, that's the only time it'll probably double, even triple for me when I got it. And then in the recent one, just before the pandemic, when you bought and then you've got that double already. Some of them in the flats, haven't they? I mean, some of the flats have actually just gone bang, doubled over, in the last 2 years, only because it's a realignment of prices.
It's been crazy to see the difference in rental value and just properties on the market in general, the change in the market from 2019 to where we are now. I think if you managed to get something before we hit COVID in 2020, you'll be singing because you'll have this property, and it will be, if you decide to sell it at this time, you'll be looking to increase your value on it. And just the market that we're in.
And if you want to sell it, please get in touch with us, even though it's out of the Fife area. And the reason for that is potentially we have people looking to buy your investment if you've got a sitting tenant, because it's less attractive with a sitting tenant, because therefore you're not able to sell it to a first-time buyer or somebody that wants to downsize or upsize to. So you can get in touch with us direct if you've got something. Also, the fact is we can assess it before you sell it, because the worst thing ever is you don't chop down the tree that bears the fruit, because your fruit's disappeared there, and that's your cash flow every single month. So if you're looking for a residual income that comes in every single month for your retirement, you wouldn't be wanting to sell your property, even though you think there's a huge gain in it. What you potentially be doing, and this has to be done properly, you would then remortgage it to get cash out in order to reinvest or do something else with. But there's rules surrounding that in terms of taxation. There's also rules. There's also risk analysis and sensitivity analysis to be done when you do that as well, to make sure that that is the right thing for you to do. You know the implications of what you're about to do when you actually borrow against your existing asset. There's so many people out there, Kerin, they actually say now is, oh, it's free money. We borrow it again from the bank. Well, it's not free money, because and you will be taxed again by the new understand mortgage deduction, interest mortgage now lower rate now, and it's no longer part of your expenditure taken off your end. You've also got applications against the Fed as well later on to into account. So these are all things you've got to think about before you sell a buy-to-let investment or before you actually remortgage a buy-to-let. Again, if shows done this all the way through on the playlist you've got in here. So landlords have always bought rental property who have bought rental property in the early 2020s. I've seen markets soar where average rent increases of 15%. That's a lot of money, eh? Driven by a shortage of supply, which shows no sign of easing, does it?
Unfortunately not.
And you say unfortunately because it's great as letting agents. I mean, and as investors and that, we're all making a really good return. But there is a point where we do feel that we'd rather have a gradual increase over a longer period of time each year, rather than actually have this one big massive increase which hits everybody all at once, which causes a huge problem and a huge implications for the wider picture afield. When you factor in a general upward trajectory of house prices, you can see the increases in capital value, and the yields continue to outperform any UK savings account. That's the key here. Yields continue to outperform every UK trading and savings account. You don't get anything in the bank really just now, even though they're pushing up interest rates. They're still at a record low compared to the 1990s, the 1980s, and also the 2000s. They're still at a record low as they were there. So what is the difference, Kerin, between gross and net yield? Can you explain that? Just like salaries, gross and net yield refer to income before and after deductions. So what is the sort of thought on that?
So there's various different factors that are taken into account for this. So the gross yield is a simple calculation of the total rental income as a percentage of the value of the property.
Yeah.
So when you're considering buying a rental investment, most yields you'll see quoted online are gross rental yields.
And that's what we should be aware of. Now, I'll pop this back and I'll show you what I meant by that. So gross yield, you've got to be aware of, and really I mean that. So gross yield here is right here, that's 6.7%, but that is this rental. So it's the total rent coming in here, if you can see that, divided by the total purchase price here. That is what gross yield is. That is all it is. But it is completely meaningless if you're getting a mortgage, because this only assumes you're buying for cash. So it's completely meaningless, because if you get a mortgage, then see how that yield changes here with the mortgage. It changes to 13.9% because you've leveraged yourself, because you're 6.7% gross yield with your cash. You're able to borrow cash at 3.5%. Therefore, you're making that differential every single time on the extra money you're borrowing from the bank, and that then leverages you up to a higher position. So that's the gross yield. In contrast, net yield, where is that then?
So the net yield is the profit after removing any ongoing cost of owning a rental property like mortgage, service charge, insurance, management fees, maintenance and repairs.
Okay, so we jump back to there again. The net yield is here, down at the bottom, net return on deposit. So that's the net, so which is here. So that's my net profit here after all the overheads, like what you said, and expenses and mortgages deducted, and then it's divided by the total amount in, because that would be, I mean, net yield isn't divided by the original purchase price. It only is if you're using cash again, remember, but if you're using a mortgage, it's divided by how much money you've got left into that property in that unit, which is here, 53,850, divided by the net income here. That's why that's 7.3%. Whereas it wouldn't be that if it was a cash, because then you'd no longer have the mortgage, but you'd still have the overheads going on. So let's see how that changed. So we've got 0 for the mortgage, and then we're there, but we've actually got the right amount in. So we're assuming it, we've done 100% in. So that net yield would change again. So that would be 100%, that would be 0 borrowing, and that would be a 4.7. See how that changes? So that would be assuming cash, 4.7. And if I change that back, see how in there it's 7.3 with the bank's money. So that's how leveraging your position's a lot better. Anyway, so that's the net yield.
I think it's really important to take into account, obviously, your net and your gross yield as well. Because, I mean, for example, I've seen on the market just now, there's a house up for sale and it has a sitting tenant in it. And it tells you what the gross yield is on the property. And I worked it out. I was like, right, would this actually be suitable to pitch to an investor for it? And looking at the gross yield for the property, the tenant's rent is a lot lower than what it typically should be in this market. So you're buying the property at the market in comparison with the market. So the property value is in line with the current market.
Yeah.
But the tenant's rent is not. So realistically, I can see why that property is still sitting in the market, because I can't see that being a viable investment for somebody with the tenant's rent.
Would you suggest to the people that, first of all, before you buy it, you should suggest that, would it be possible to increase the rent for the tenant sitting in there now, before you actually make any commitment? Is that your suggestion?
That's the thing. You have to take into account these things when you're doing buy-to-lets on a sitting tenant. You have to know what the rental value is for a property, what the current tenant is paying for it, and if they have that potential to be able to pay more in line with the current market. If they're in a position that they're not able to increase the rent and pay any more for it, then you could end up in a sticky situation where you have a tenant that is paying a lower rent or decides to stop paying it, or that you have one that you then can't get out of the property and you have a property that's got a tenant in it, and it can end up in a really difficult situation. Yeah. So when you are doing buy-to-lets with a sitting tenant, it's all this risk analysis that you need to be taking into account, and obviously working out your gross yield and your annual one, so you can make sure it will be a viable investment for you.
So don't forget the running costs of the various different property types. There will be different. For example, Mill Street in Kirkcaldy, I know this myself. I've got a property factor. They charge 60 quid a month. So you're talking about another 720 off your bottom line. So if you're making £1,800, you're now making about £1,200. So you've got to build these costs in. So make sure you're aware of every single cost that's involved on different property types and what they're doing. A flat converted from a house will have a smaller service charge than a luxury apartment complex, but extra facilities often attract higher rents and professional tenants. Again, it's all your knowledge, isn't it, Kerin, that we'll go to, and then we'd ask you for that information. Now, we covered briefly about calculating the rental yield from the buy-to-let as well. So we've covered that as well. I mean, as a rule of thumb, the gap between your gross and net rental yield should be no more than, what, 2%? If it's a difference is wider, then check potential savings in your outgoings like mortgage payments and insurance, or whether your rent income has fallen behind the market value and needs to be reviewed. One of the things, and I know we'll not, well, as a letting agent, we're obviously not a big fan of advocating this, but I do say this to everybody when I go back to this, is when you're calculating in this scenario and you know down here that you've got a net profit in there of 5,500 out of 3 properties with a 54,000 in, and you bought them at that level and they were rented at that price. One of the things I always look at, even though if anything dire does happen, you've always got a 15% in there, a factor in there for management fees. So if you ever had to, then you could potentially bring that down, which would actually increase your profit. But why I'm saying that is because if you did have rent controls in and suddenly it changed, then you'd still survive. You'd have a huge margin leeway. See in there how it's 3,000 just now. If rent controls came in and it did go down to 300, for example, and then occupancy rate dropped as well, you'd still be hedged against it. And if you really needed to and it got to the wire, then you've still got a tolerance in there that you could self-manage. I mean, you get us to manage because you've got no time. That's really it, and our expertise and our knowledge. But if it really did come to it, you could be in a position where you could protect yourself anyway and do that. So I always advocate that's why you build that into overheads. So you've got some sort of margin again to protect yourself against any mass swings in the economy and the economic situation. So that's why we talk about the rental, the net and the gross rental yields. So probably my final question is, why would I need to track my rental yield? Well, it's a sensible business decision to keep an eye on the progress and profitability of any investment. I mean, that's clear. We do it every single time. We should do it every single time. I mean, I watch the stock market every single time. I don't know why. It's just a force of habit. I'm looking to buy anyway, to be honest. So I'm kind of waiting. Is this going to bottom out at 7,000, the FTSE, or do you think it should go down to 6.5? And at that point, should I jump in and buy? But I've got till the end of this tax year before I do that, because it's obviously to mitigate my tax position, because I get a deduction from a higher rate for my pension. Hence the reason why I'm thinking like that. And that's just another wee strategy you could think of in order to mitigate your tax position and actually be more tax efficient in what you're doing. So rising property values are highly visible, and your increase in equity will open up more options around refinancing in the future. And this is the one we talked about. The less immediate obvious are the changes to your rental yield against the capital value. But by tracking your rental yield, you can monitor the ongoing performance of your buy-to-let within the local market and against national trends. What's one of the other ones, Kerin?
So you can create a plan for improvements and upgrades to increase your income and add more value to you.
That's a brilliant one. And then you know yourself that I always look at it before the end of the tax year, don't I? And I kind of think, where am I going to land? Because I mean, this is pretty easy to forecast. If you've got rents coming in every single month come hell or high water, and you know what your income is going to be every single month, by the time you get to the beginning of next year in January, before the end of the tax year, you pretty much know where your income is going to come in and how much is going to come in every month. So you can forecast what your profit's going to be before the end of the tax year. And therefore, you can then say, is it worth actually doing improvements now? In other words, capital, no, I mean, there's no much as capital expenditure anymore. That's another story completely. But most deductions against your income now on terms of repairs and improvements tend to be instantly deductible. I mean, replacing a kitchen is instantly deductible. Replacing double glazing is instantly deductible. Putting in a heating system is instantly deductible. It's all normally instantly deductible against your income. So if you want to mitigate your tax position and actually bring your tax bill down a bit because you're thinking, oh, it's going to push me into a higher rate, or it's going to be even more than what I expected, and I want to bring that down and defer that tax liability, because remember, you're only deferring it. You're only spending the money this tax year in order to offset it against next tax year. So you're bringing it down and maybe deferring it till the end of the next tax year to pay, because all you're doing is bringing it down, spending it this year instead of spending it the next tax year. So that's all that's doing. But it is perfect for creating that plan for improvements and upgrades to increase your income, as Kerin said, and add more value to your property, because then you've got it done beforehand, it's done quicker, and therefore it's potential to decide whether you keep the property or expand your rental property or sell up. And by a mean expand, you're talking about refinancing, which we talked about previously, aren't we?
Exactly.
So for an accurate rental comparison, pick a recurring date that's right for you. Possibly that's maybe the advice I would give. That could be the anniversary of your purchase, the end of the tax year, or perhaps a start of a new calendar year. Now, what I mean, and this is, Kerin, you probably are going to ask me this question anyway, so I'll preempt it. Why would I check for an accurate annual comparison, and why would it be the same time every single year? Because it's comparing apples with apples. So, for example, seasonal fluctuations in the property market. If I was to say property prices had increased in April by 13%, but then I said I'll compare that against how they'd increased by December. It's kind of no like for like. That's why you get all the pundits on the telly and all the forecasters. They're saying, well, the increase in annual prices increased by 13% this year, but year on year, the year before, they had increased by 6%. So they actually go back the 12 months and they actually compare like with like, and to take out potential seasonal fluctuations. Classic example probably happened recently, and I talked about it last night on the weekly market update. I did talk about it in yesterday's show about has the market peaked and are we plateauing in terms of house prices. What I talked about was the leveling up, and the fact that compared against last year, house prices have gone up 13.8%. But if you look at last year, we had a spike towards the March and April, when everybody started to buy property pretty quickly before the end of the stamp duty period actually came off from the government. And so they all rushed in at once and bought property, and that pushed all the prices up so quick. So that was factored into that 13.8% increase, because everything had gone up so quick and demand was so quick as well. And that's why they think, or what we think, well, I would probably say that as well. That's why we think it will start to level off a bit. Now, I know some of the bigger organisations are forecasting this year for increases of 4%, and 4% the next year, 4% the next year. But that's a pretty good return.
Yes, indeed.
Because you're getting paid to wait. You're getting paid to wait as well when the property goes up in value. So, next steps. What would you suggest are the next steps then for anybody wanting to start, or maybe they're seasoned property investors? Well, what about for somebody that wants to get started? What would you suggest for them?
So if you're looking to get started, obviously making sure that you are in contact with the right people for it, I would say. Making sure that you're speaking to agents that can give you the information like we have today.
Yeah.
You need to make sure that you're getting an up-to-date assessment of the current rental value on a buy-to-let that you already own, or how you can increase its performance.
So that would go for existing property investors as well, wouldn't it?
It would, exactly. That's the thing. If you've got an existing property, you can get, I think, what we call the property MOT, so you can get an up-to-date.
Yeah. I was just about to say that, Kerin. How many landlords have you come across and you've looked at their current rents and you've gone, oh my God, you're not getting the right return?
Yes, especially in the current rental market, or we've had one maybe that they've had a tenant in it for a lot of years and it's been going smoothly, and they've not wanted to increase the rent because they've had that good tenant. But for example, the tenant's moved on. It's like, right, okay, well, you're going to see a big jump from what you used to have the property on at compared to what you're going to put it on it now in the current market. So just even speaking to landlords and making sure that they are getting the right rental value for their properties.
Now, how and why is it so important to get the right rental value then? Because often somebody out there listening into this would think that's just being greedy. But why is it important to get that right rental level?
So this is making sure that you are making your investment work for yourself, as well as you're having the money to pay the mortgage for it if you have one, and keep the maintenance of the property ongoing as well. So the rent that a tenant is paying is obviously going towards a mortgage payment perhaps, and obviously the ongoing costs of running the property. So making sure that your roof is still in a good condition, your boiler, your kitchen, bathroom, everything that's in it. I know, for example, even one of your ones, Jim, we had it, this was a wee while ago now, it only popped into my head because I saw the tenant the other day. But it was a really good tenant. The property was good, but we had a carpet that was a bit worn, maybe seen better days. And she was looking after the property so well. She paid her rent on time every month. So we put a new carpet in because she was looking after it. It was making a nice home for her. And she's been in there for about 4 years maybe now.
Yeah. Well,
so
I'm saying yes.
I don't know. I keep track of them.
I don't know. I'm just letting you decide.
But it just shows you these little changes. So a tenant paying the rent and paying the right level of rent is giving you this income to be able to invest back in your property as well and make a good home for somebody that they want to stay in. In the long run, this is going to benefit you because you're going to reduce your property's vacant period and have a tenant that's happy and paying their rent.
Yeah. I mean, that is a really good one because occupancy rate can really seriously affect things, can't it? I mean, when you think about the logic of that, if you've got a £500 a month rent, for example, just say, for example, I mean, we're talking about an average rent here, and you were saying in your news bit in the beginning, you're talking about an average rent in Fife of £616. So if you took an average rent of £616 and then said to yourself, if I was empty for 1 month, you'd be losing £616 in that 1 month. But not only would you be losing that 1 month, you then have to pay for another tenant to go in, which would essentially be probably another 600 quid overall when you work out the amount to go in, the amount to advertise, the amount to reference, the amount to deposit and lodge a deposit, and all these different things added together would make that segment. So you effectively lost 2 months rent, and then possibly because the tenants moved out, you might have to do a simple refurb or simple improvements because the wear and tear on the property. Now the tenant lives in it, so they weren't particularly bothered about the wear and tear because it's wear and tear over time, but it's not deductible against the tenant's deposit because it's normal wear and tear. So then you would have to refurb the property a wee bit, which could cost, again, the cost of the carpet, the cost of maybe a bit of painting and decorating, the cost of maybe a bit another carpet somewhere else, the cost of a wee bit of clean up, and maybe the cutting in the back garden as well. And these are all things that are just minor things, but when you tally them all up, it could be the best part of £2,000 you're out of pocket. And then you've got a tenant that you don't even know yet because they've only been referenced and moved in for the first time. Whereas the tenant you had just now, and all it needed to do was just give them a carpet at minimal cost, would have saved you all that bother and all that hassle, and have somebody consistently staying with you. So see how that all works in, and how that makes a fundamental difference to the overall occupancy rate, to the overall return, the overall yields in terms of what you're getting as well.
It is, and I think that's one of the biggest takeaways that we can take from today is looking at the big picture of things, looking at that overall, what's going to come up in your year for it. Is this going to how to maximize your investment over the course of a year, and not just looking at a year plus, and not just looking at the short-term picture for it, but how you're going to get from month to month.
Perfect. Okay. So if anybody wants to get in touch with you, how can they get in touch with you?
So you can give us a call into the office. So our letting side is 01333 424 188, or I will pop my email in the bottom of this, so you can also drop us a wee email if that's easier for you.
Perfect. Okay. Thanks very much, Kerin. I really appreciate that. Thanks for coming on the show and discussing with the rental yield and how important that is in terms of tracking business indicators, and how it's an essential key indicator in terms of making sure your investment in buy-to-let portfolio grows over a long term of time. And until next time, guys, until the Wealth Creation Show next week, it's bye-bye from us. Bye from her. You're supposed to say it's bye-bye from him.
And goodbye from him. Other side.
Bye, folks.